Hey everyone, Kieran King here. Today I'll be looking at how a small fund named Archegos caused an avalanche 30 billion stock fire sale a few days ago. Imagine you go to four mates separately, borrow £1,000 from each without telling the other, and then go to a casino and put it all on red. That is basically what happened. Anyways, let's elaborate. It all starts with this guy, Bill Huang. In 2001, Huang launched a fund called Tiger Asia Management, which became quite successful until 2012 when Bill was found guilty of insider trading and market manipulation. He was basically fined millions and was banned from the Hong Kong market. Bill then decided to turn the fund into a private family office. Enter Archegos. Now, a family office is basically a fund for wealthy families, and it usually falls outside the scope of US regulatory oversight and scrutiny, given that it is, by its name, private. Anyways, family offices and funds have the goal of investing in assets to deliver returns for its members or shareholders. Now, an asset could be a stock, property, cash, crypto, anything really. Bill Huang, however, invested into more complex instruments known as derivatives, which means he is investing in assets in an indirect way, and he did this mainly through something called total return swaps. So what is a total return swap? There are two parties involved in a total return swap, a payer and a receiver. The receiver, in this case Archegos, goes to an investment bank like Goldman Sachs, which is the payer, and says, look, I will pay you over a period of time a regular set fee with interest, and in return you will take positions in certain companies and pay me the returns that you make. These returns could be in the form of dividends or just simply capital appreciation of the stocks. Now, some of you might be thinking, well, why doesn't Archegos just invest in positions directly in these companies as opposed to going through an intermediary? The answer is margin. These payers, i.e. Goldman Sachs, can offer margin to the receiver, i.e. Archegos, allowing Archegos to basically put a tiny amount of what is needed to take positions in those stocks. So, for example, for Archegos to get, say, 10 shares in a particular stock, it would only have to show it has the money for 2 and can borrow money from the investment bankers for the remaining 8. Experts say Archegos was borrowing $5.6 for every $1 of its own money. Now, this all works well if the stocks that were invested in do well. What happens, however, if a stock starts to fall and do poorly? Well, these bankers like Goldman Sachs start to worry, and then they call up Archegos and say, look man, in order to maintain your underlying position in this stock, you're going to have to put up more capital up front in case it goes sour. And this is known as a margin call. As an example, this might mean Archegos may have to put up $2 for every $5.6 borrowed, as the risk is greater. So no biggie, Bill Huang will just have to put up more capital up front, right? Well, you would think, but here's where it goes wrong. Archegos not only had contracts with Goldman Sachs, but also with other banks such as Morgan Stanley, Credit Suisse, and Nomura. And not only that, Archegos was taking the exact same positions in underlying stocks with these other banks, companies like Discovery and Viacom CBS. So when one of these stocks starts to fall, like it did, suddenly all these bankers start calling up Bill and asking him to put up more capital up front, capital that Bill simply did not have. He was over leveraged. And so as a result, these banks go, well, if you can't pay, then we aren't keeping these positions for you anymore. And thus they end up selling billions worth of these underlying stocks. And what happens when there is more sellers than buyers? The price of the stocks goes down. So that is it in a nutshell. What are the key takeaways here? Firstly, this saga has inflicted some serious systemic damage to the market, and there is a debate whether family offices should be subject to the same scrutiny and regulation that other funds are. Should they have to disclose certain derivatives and investments to the world? If, say, Goldman Sachs knew that Archegos had the same positions it was gunning for in Morgan Stanley, it perhaps wouldn't have allowed Archegos so much margin or leverage to trade with. Second is the issue of diversification. The fact that Bill Huang took out these total return swaps with lots of investment banks in the exact same companies beats me. As I said in the beginning, it's like going to four mates separately, borrowing $1,000 from each without telling the other, and then going to a casino and putting it all on red. At least diversify it to a certain extent to increase your chances of success, and that is investing 101. Third, how many more Archegoses are there out there in the world? Investment banks will need to start looking a lot more closely at the firms it does business with. Anyways, that's another video for me today, folks. What do you think? Let me know in the comments. If you enjoyed this video, please subscribe for more. Take care, everyone, and I'll see you all soon.